In 2026, the Federal Reserve tracked something strange. Americans who carry a credit card balance are now paying an average interest rate above 21%. That is not a recession number. That is right now, in a stable economy. And here's the part that should bother you. A lot of the people carrying that debt have six-figure salaries. So what exactly is going wrong between the paycheck and the bank account? Most professionals between 40 and 60 believe income is the scoreboard. Get the raise, get the bonus, and the number goes up. But somewhere in that stretch of life, the scoreboard quietly stops mattering. Your income can climb every year, while the number underneath it, the one that actually decides when you retire and on whose terms, barely moves at all. So if income is not the number that matters, what is? There is a single number that tracks whether you're actually getting ahead, and it has nothing to do with your salary. That is what this video is about. Ignore it, and you can keep earning raises for the next 15 years and still feel exactly as tight as you do today. My name is Alex, and if you have ever done the math on your own retirement and come up short, even though you did everything right, stick around because the problem was never the math. It was which number you were watching. I'm going to show you the 7 specific moves that separate people who retire on their own terms from people who retire on a compromise. Once you understand which number actually drives your future, you will stop checking your paycheck for reassurance and start checking something else entirely. And that shift begins with a question almost nobody your age has actually sat down and asked themselves. Track what you keep. Dave Ferris makes $210,000 a year as a regional sales director in Charlotte, North Carolina. He got a raise this spring. He leases a BMW X5. His wife carries a Louis Vuitton Neverfull she bought for their anniversary. On paper, Dave looks like someone who is winning. So here's the question nobody asked him at his last performance review. What is he actually worth? He didn't know. He'd never calculated it. And when he finally sat down and did the math, assets minus debts, everything he owned minus everything he owed, the number surprised him. It was smaller than his salary. A man earning $210,000 a year, and his entire net worth didn't even clear that figure. Here's why that happens to so many people in their 40s and 50s. Income measures what passes through your hands. It says nothing about what stays. You can get raises every single year and still be flat, or worse, quietly moving backward. Because the raise gets absorbed before it ever turns into ownership. The lease payment goes up, the vacation gets nicer. The number that was supposed to represent progress just becomes the new floor. According to the Federal Reserve's most recent household data, the median net worth for Americans between 45 and 54 is around $247,000. For people between 55 and 64, it rises to around $364,000. Those numbers include the house. They include the 401k. They include everything. And for a lot of high earners, that median is uncomfortably close to home, or even ahead of them, despite a salary that should have put them well past it by now. This is the actual shift that changes everything downstream. Stop asking what your income looks like this year. Start asking what you're worth right now, today, if you added up every asset and subtracted every debt. That single number reframes every decision that follows it. The question stops being, can I afford the monthly payment? It becomes, does this purchase move me forward or does it move me backward? Dave ran his own numbers again a few months later, after he started tracking net worth instead of income. The BMW lease was quietly draining $940 a month with nothing to show for it at the end. That single number told him more about his financial trajectory than his paycheck ever had. That's the mindset. But mindset alone doesn't build anything if there's a leak in the system working against it every single month, quietly undoing the progress before it has a chance to compound. Kill the debt first. Renata Cole didn't think of herself as someone with a debt problem. She runs a dental practice in Scottsdale, Arizona, and she pays every bill on time. But there's a difference between paying on time and actually paying it off. And that difference was quietly costing her more than her mortgage. 2 years ago, Renata put a Chanel Classic flat bag on a card during a trip to Los Angeles. $10,800. She meant to pay it off in a month or two. Life got busy. She kept paying the minimum and the balance never really moved. That's not carelessness. That's just how the math is built to work. Here's the mechanism nobody explains clearly enough. Not all debt behaves the same way. Acquisition debt, The kind you take on to buy a house or a piece of equipment for a business can actually work in your favor over time because the thing you bought tends to hold value or produce income. Consumption debt is the opposite. It's money borrowed for something that's already gone by the time the bill arrives. And right now, the average interest rate on that kind of debt is sitting around 21 to 22%, according to the Federal Reserve, with some new credit card offers running as high as 25%. That's near the highest level in the history of the data. Let's run the actual math, because the number is worse than it sounds. Carry a balance of $5,000 at 20% interest and pay only the minimum each month. And Bankrate's own calculations show it takes about 23 years to pay off. Total interest paid along the way, around $7,723. That's more than the original debt itself, just to borrow $5,000 for a little while. Now stretch that same math across Renata's actual balance, which had crept closer to $18,000 once dental supply costs got added to the same card. At current rates, minimum payments alone would have kept her paying into her 60s. The bag was $10,800. The real cost, paid in slow motion over 2 decades, was closer to double that. This is why consumption debt deserves a different name entirely. Call it what it is. It's not a convenience. It's a financial vampire, quietly draining money you'll never see turn into anything. Every dollar going toward that interest is a dollar that isn't compounding in your own direction. It's compounding in someone else's. Renata paid off the balance in 4 months once she saw the real number attached to it, not because she suddenly earned more, because she finally understood what letting it sit was actually costing her. Debt like that is loud once you calculate it, but there's a quieter number waiting on the other side of 40, one tied to a much bigger monthly payment, and it decides something even bigger than a handbag. Max out your 50s. Greg Halloran didn't think much about his 401k contribution rate for almost 20 years. He'd bump it up a percent here and there, mostly when HR nudged him during open enrollment. He's a plant operations manager outside Cincinnati, Ohio, and by his own account, retirement felt like something for his 50s to worry about. Then he turned 50, and the rules quietly changed in his favor, whether he noticed or not. Here's the part almost nobody explains clearly. Once you hit 50, the IRS lets you contribute more to your retirement accounts than everyone else, on top of the regular limit. This year, the standard 401k contribution limit is $24,500. But if you're 50 or older, you can add another $8,000 on top of that. And if you're between 60 and 63 specifically, that catch-up jumps even higher, to $11,250. That's not a rounding error. That's an extra decade of aggressive saving compressed into what's left of your working years. Now here's where it gets strange, and where a lot of higher earners are about to get caught off guard. Starting this year, if you earned more than $150,000 in wages the previous year, your catch-up contributions can no longer go in pre-tax. They have to go in as Roth, meaning after-tax dollars. For Greg, who cleared that threshold 2 years ago, this changes the math on when he pays the tax bill, not whether he gets to save the extra money. He still gets the full catch-up. He just pays Uncle Sam his share now, instead of in retirement. Let's run Greg's numbers. He's 52. He starts maxing out his standard contribution plus the full catch-up, $32,500 a year combined, invested at a conservative 7% average return. That's roughly $450,000 built over the next 13 years just from this one decision, on top of whatever he'd already saved. That's the difference between retiring on schedule and pushing it back 5 years past 65. Most people treat their 50th birthday as purely a milestone about how old they feel. Financially, it's closer to a checkpoint the tax code built specifically for you. It exists because lawmakers understood something true about real life. People in their 20s and 30s are paying for daycare, mortgages, and braces. The 50s are often the first real window to save aggressively, and the IRS quietly widened that window on purpose. Greg didn't buy anything flashy with this discovery. He just increased his contribution percentage by 6 points and never noticed the difference in his paycheck. That's the kind of decision that doesn't feel dramatic in the moment. But that 13-year runway only works if the biggest bill in his budget isn't quietly working against him at the same time. Stop paying the wrong loan. Lauren Whitfield refinanced her house in Denver, Colorado 2 years ago and felt pretty good about it. Then she made an appointment with a financial planner just to double check her retirement timeline. And he asked her one question that stopped her cold. Why was she still making extra principal payments on a mortgage at 4.1%, while her cash sat in a savings account earning less than that? Here's the tension almost nobody resolves cleanly. For decades, paying off the house early was treated as an obviously smart move. Full stop. And there's real emotional logic to it. A paid-off house feels like safety, but the math underneath that decision has actually flipped, and it depends entirely on the interest rate sitting on your loan. Right now, the average rate on a new 30-year fixed mortgage is sitting around 6.5%. If you locked in your rate back when they were in the threes, you are, without exaggeration, holding one of the best deals in modern American finance. Paying that loan off early doesn't just fail to help you, it actively works against you, because you'd be using extra cash to eliminate a 3% debt instead of investing that same money somewhere it could reasonably earn 7 or 8% over time. Lauren's case made this concrete. She and her husband bought their house for $620,000, a 4-bedroom colonial near Wash Park, and locked in a rate of 3.4% before the market shifted. She'd been putting an extra $800 a month toward principal, feeling responsible every time she did it. Her planner ran the numbers instead. That same $800, invested monthly in a standard index fund averaging 7% annually, would grow to roughly $209,000 over 15 years. Paying down a 3.4% loan early, by comparison, saves you exactly 3.4%, guaranteed, and nothing more. Now, if you're the one holding a mortgage at today's 6.5% instead of Lauren's 3.4%, the math actually leans the other way, and paying it down early starts making real sense again. That's the part that gets left out of every generic finance headline. There's no universal answer here. There's only your specific rate, compared honestly against what your money could otherwise be doing. Here's the preempted objection, because I know what some of you are thinking. What about the peace of mind of owning a paid-off house? That's real, and it's worth something. But peace of mind has a price tag. And for a 3% loan, that price tag is often $200,000 of lost growth. Know the number before you decide it's worth it. Lauren redirected that $800 into her brokerage account instead. The house is still there, but now something else is quietly growing alongside it, aimed at a number most people her age have never actually calculated. Find your freedom number. Sandra Boyd sat across from a financial advisor in Tampa, Florida, and asked the question she'd been avoiding for a decade. Am I actually going to be okay? Not someday. Not eventually. She wanted an actual number, and she wanted to know if she'd already hit it, or if she was still years away. Here's the number almost nobody calculates until it's too late to act on it comfortably. It's called your retirement number, and it comes from a simple rule financial planners have used for decades. Multiply your annual expenses by 25, and that's roughly the amount you need invested to sustain yourself in retirement, drawing down about 4% a year without running out. Sandra's household spends about $100,000 a year. So her number, the actual finish line, is $2.5 million. Now here's where it gets interesting and where a lot of people your age are sitting on better news than they realize. Sandra is 51. She's got $850,000 already invested across her retirement accounts. She assumed she was nowhere close. But run that $850,000 forward at a conservative 7% average annual return, with 0 additional contributions between now and 67, and it grows to roughly $2.5 million entirely on its own. Compounding does the rest. She doesn't need to add another dollar to hit her number. She just needs to not touch it. That's the concept some planners call coasting, and it's genuinely strange the first time you hear it explained. Once you've invested enough, time and compound growth finish the job without you. Money that used to feel like it needed constant feeding suddenly runs on its own momentum. Sandra had spent 3 years stressed about maxing out every account, when the real answer was that she'd already crossed the threshold where the math takes over. What changes once you know your actual number? Everything, honestly. Sandra stopped treating every dollar like it had to go toward retirement out of guilt. She and her husband put $22,000 into redoing their kitchen instead of adding it to a brokerage account that didn't need it. She finally bought herself a Cartier tank Française she'd wanted for years, in steel, no diamonds, $4,200, and didn't feel a flicker of guilt over it. Knowing the number didn't make her reckless, it made her precise. She could finally tell the difference between money that needed to keep working and money that had already earned its freedom. Most people never run this calculation, so they either save too aggressively out of fear or not aggressively enough out of denial. Either way, they're guessing. Sandra isn't guessing anymore. But a number like that assumes your only source of growth is a retirement account tied to a paycheck. And for a lot of people your age, that paycheck isn't actually the biggest lever left to pull. Trade salary for ownership. Nathan Pruitt had the best year of his career last year. A promotion to VP of operations at a logistics company outside Memphis, Tennessee, and a raise that pushed his salary past $200,000 for the first time. He leased a new Audi Q7 Premium Plus to celebrate, and yet, when he ran his net worth calculation, the number barely moved from the year before. How does that happen after the biggest raise of your life? Here's the mechanism nobody explains at the promotion dinner. A salary has a ceiling, no matter how good you are at your job. Somebody above you decides the budget, and even the best performance review in the world only moves that number so far. Your income is capped by someone else's decision. Your net worth doesn't have to be. According to the Federal Reserve's own wealth data, nearly half of American families in the top 10% of net worth own a piece of a private business, not a side hustle for extra spending money. An actual ownership stake, something that grows in value, independent of how many hours they personally work. That's not a coincidence. Salary pays you for your time today. Equity pays you for the future value of something you helped build, whether or not you're the one clocking the hours next year. This is where the philosophy actually gets useful. Nathan's company started offering employees the option to convert part of their annual bonus into equity instead of cash. Almost nobody on his team took it. It felt abstract, uncertain, harder to picture than a check landing in his account. Nathan took it anyway, 3 years running, trading roughly $15,000 a year in bonus cash for ownership stakes in the company itself. Here's the part that's easy to miss about opportunities like that. The downside was capped. Worst case, the equity ends up worth less than the cash would have been. But the upside wasn't capped at all. When the company got acquired last year, Nathan's stake, built from 3 modest bonus conversions, was worth close to $190,000. That's an asymmetric bet. Small, defined risk on one side, uncapped, life-changing potential on the other. That's the real separation between people who stay comfortable and people who actually pull ahead. It's not working harder. Nathan didn't work more hours than his coworkers who took the cash bonus every year. He just aimed a portion of his income at ownership instead of consumption and let time do something a paycheck never could. He still drives the Audi, but sitting in his brokerage account now is a stake that's already worth more than the car will ever be, quietly outgrowing the thing it's parked next to. Which brings up an uncomfortable question. What happens to everything you've built here if something happens to you before you get the chance to enjoy it? Protect what you built. Curtis Yang had a Patek Philippe Nautilus sitting in his safe, a paid-off consulting business worth well over $1 million, and no will. He's 56, based outside Austin, Texas, and when his business partner asked him point blank what would happen to all of it if he didn't wake up tomorrow, Curtis realized he genuinely didn't know the answer. Here's the uncomfortable truth about everything covered so far. None of it matters if it isn't protected. You can track your net worth, kill your debt, max your catch-up contributions, and build a real ownership stake, and still hand the whole thing over to probate court because you never signed 3 basic documents. Let's start with term life insurance, because the math here is simple, and most people still get it wrong. If anyone depends on your income, financial planners generally recommend coverage worth 10 to 12 times your annual salary. Curtis and his wife live on a combined income of $180,000 a year. That means he needs somewhere between $1.8 and $2.2 million in term coverage, not because he's wealthy, but because that's what it would actually take to replace him. Next comes estate planning. And this is where Curtis's story gets specific. He and his wife own a waterfront property on Lake Travis worth $1.4 million. Without a will, that property doesn't automatically pass to his wife the way most people assume. It goes through probate first, a court process that in Texas alone can take months and cost thousands of dollars in legal fees, sometimes as much as 5% of the estate's value. On a home worth $1.4 million, that's up to $70,000, paid to lawyers and court costs. at the exact moment his family is least equipped to deal with it. A basic will, and a power of attorney, documents most attorneys can draft for a few $100s, would have made that entire cost disappear. Then there's the conversation almost nobody wants to have, but every financial planner will tell you changes everything downstream. Call it the 70-40 rule. When your parent turns 70, or when you turn 40, it's time to sit down and actually talk about their finances, their long-term care wishes, and what happens if their health changes suddenly. Curtis kept putting it off with his own father for years. It's an uncomfortable conversation. But the families who have it early are the ones who aren't blindsided later by decisions nobody agreed on in advance. Curtis fixed all 3 gaps in about 6 weeks: term policy, a proper will, and one long dinner with his dad that he'd been avoiding since his father's last birthday. None of it was expensive, none of it was complicated. It just required admitting that building wealth and protecting wealth are 2 completely different jobs, and most people only ever do the first one. 7 moves. 7 decisions that quietly separate the people who coast into their 60s on their own terms from the people still hoping the math somehow works out. Pick your number. None of this was ever about being smarter than everyone else. It was about which number you decided to watch. Income tells you what passed through your hands this year. Net worth tells you what you actually kept. And that's the number that decides whether 65 feels like freedom or a compromise. A few things worth carrying with you. Debt at 20% interest is not a bill, it's a leak. A 3% mortgage is not a burden, it's leverage. Catch-up contributions exist because the tax code assumes your 50s are your real window. Ownership pays for a future a paycheck never can. And none of it survives without a will protecting it. So look at your own numbers this week, not your salary, the real one, assets minus debts, written down honestly for the first time. Notice which of these 7 moves you've already made, and which one you've been avoiding for a reason you haven't said out loud yet. There's a version of you at 65 already watching how this plays out. The 7 moves are simple. Making them on purpose before the window closes is the actual work.